All right. Um, it's going to be a flat start for SGX. I think that is clearly visible, and that is empirically evident in the way how the global cues are also shaping up. Even checks on the handover from US market, the dollar index is at a 1 week low and gold is below 18,000. So you cannot derive anything which could be called as a very comforting news, at least from the global market, but not that global cues are scary. Devang Mehta joins us. Let's take a conversation forward with him. Devang, we've seen extreme volatility in metal stocks. Why is that?
Good morning, Nikunj. Thanks for having me on the show. I think the last 10 days, we are all sort of crowded with the news of what's going to happen with the liquidity, excess liquidity that is in the system. We had a different type of remarks coming in from central banks across the world. Also, there was indication of probably this easy money policy not going to continue till eternity, which I think I've been vocal saying that all stock and commodity investors want this liquidity to continue for some more time. But I think there are enough indications that in the next 6 months, 1 year, there would be at least a little bit of the taper tantrum, which would come back to the fore for a lot of economies and even markets across the world. So my sense is that in a risk-on sentiment, yes, metals were doing well. They came out of a extremely bad cycle since the last 4-5 years. The cycle still seems to be good, of course, but it's very, very difficult to time how metal prices would pan out, how China would pan out. Though US talks about probably trimming its liquidity, but there is a $1 trillion package which it has announced for infrastructure. So I think there are so many moving parts that it will be extremely difficult to focus on metal stocks and how that behavior would be going forward. But yes, that's brought in a lot of volatility. The tug of war between the bullish sentiment and the bearish sentiment for metals going forward has sort of created this type of volatility in the minds of investors. And I think a lot of people have made so much money on the table that why not take something off the table, at least take out your capital. That is what a lot of investors are thinking about.
Hi Devang, this is Mubina as well joining in. Well, investors have made quite a bit of money in IT too. But that continues to do well. It's been, in fact, among the best performing series, the best performing, counter in the August series. Do you think that, as we once again enter that phase where we don't know what the Fed will do, and there's this entire taper talk that's going on, people would like to play, a relatively safer defensive theme like IT?
That's an excellent question. What we have seen over the last 1 month, in fact, in the August month itself, as you rightly said, IT index, Nifty IT has rallied by roughly around 12.5%, whereas your banks, the banking index has rallied by just around 3%. So that shows you how the sector rotation has taken the front seat. Very importantly, while we talk about risk of sentiment probably coming in, people waiting for the Fed, what they are talking about, IT as well as even FMCG. If somebody has seen in the last 10-15 days how companies like Nestle, Britannia, Marico, Dabur have also started to do well, coming out of their underperforming 6 months. What we are seeing is a lot of people are now enthused that IT going forward is going to be the most important sector in terms of raising your productivity, in terms of not only IT products, but even IT services, robotics, artificial intelligence. So tech and IT as a sector would probably continue to do very well. It also is India's competitive edge. One most important part is a lot of these companies now where we talk about are not only localized in their services, but also does it do a lot of exports, which we all know which has been India's traditional strength, the typical IT companies like Infosys, TCS. But a lot of mid-cap companies have also come back to the fore and started to deliver excellent numbers. And the commentaries have been very robust. So my sense is, yes, if one needs to be in this market for the next 3-5 years, IT will continue to do well and provide optimal in the way good returns if you compare it to even your index returns.